Look, you've decided to start investing. You open your brokerage app, ready to build your wealth, and suddenly you are paralyzed. There are over 10,000 different stocks out there. Apple, Tesla, some random mining company in Australia. How do you choose? What if you pick the one company that goes down? The psychological weight of the paradox of choice kicks in, your anxiety spikes, and you end up doing nothing. You leave your money in cash, where inflation slowly eats it alive. But what if I told you that you don't have to pick a single winning stock to become wealthy? My name is B. By creating this channel, we wanted to give vent to our curiosity by analyzing books, analyzing thought processes, and trying to understand finances just to be greater. By creating this channel, we are consolidating our knowledge on many issues important to us and breaking the problem down into its constituent parts. My quick reminder, this video is for educational purposes only and is not legal financial advice. Always do your own research. Here's the thing. The wealthiest investors don't waste time trying to find the needle in the haystack. They just buy the entire haystack, and they do that using ETFs, exchange-traded funds. Think of it like a variety pack of cereal. Instead of betting all your money on one giant box of cornflakes, hoping you'll like it, an ETF gives you a box with 500 mini boxes inside. If one brand goes out of business, you barely notice because the other 499 are still there. But once you decide to buy ETFs, you hit another wall. There are over 3,000 of them. Where do you even start? We are going to use a tool called etfdb.com. It is one from many different ETF browsers, which will serve as an example. It is essentially the encyclopedia of ETFs. It breaks this massive, chaotic universe down into logical constituent parts. Let's look at the three main ways they categorize the market. 1. By type, the what. When you go to the type section, you are choosing what asset class you want to own. Sectors. Maybe you believe the future is purely in technology, or healthcare, or clean energy. You can buy a tech ETF that only holds tech companies, commodities and bonds. You can even buy ETFs that track the price of physical gold or baskets of corporate bonds, our shock absorbers from the last video. Broad market. You can buy an ETF that tracks the ES and P500. With one click, you own a tiny slice of the 500 biggest companies in America. 2. By geography, the where. B. Isn't it risky to only invest in the United States? Yes, and ETFDB lets you filter by geography. You can buy a ETF to own the biggest companies across the EU or Asia. You can buy an emerging markets ETF to invest in developing economies like India or Brazil. Or you can just buy an all-world ETF and literally own a piece of the entire global economy. 3. By issuer, the who actually manages this basket of stocks. This is the issuer. You will see massive names like Vanguard, iShares, run by BlackRock, and State Street. Why does the issuer matter? Because of the expense ratio, ER, the tiny fee they charge you for managing the fund. Vanguard, for example, is famous for driving these fees down to practically zero, like 0.03% a year. You want to stick to reputable issuers with massive liquidity and low fees, so they don't eat into your compounding interest. Now, you might be thinking, okay, B, I used ETFDB, I filtered by US broad market, and I still have 20 different ETFs staring at me. They all look the same. Which one do I actually click buy on? This is where we bring in the heavy artillery. ETF comparison tools like ETF.com. There is a literal compare tool. You punch in 2 tickers. You can see exactly which one has the lower expense ratio, so you aren't overpaying on fees. But here is a crucial thing. These tools let you check for fund overlap. Let's say you buy a tech ETF and a broad market ETF. You feel incredibly responsible. You think you are diversified. But when you punch them into a comparison tool, it reveals the truth. Both ETFs are heavily concentrated in Apple and Microsoft. You aren't actually diversifying your risk. You are just paying 2 different managers to buy the exact same companies. Comparison tools strip away the marketing, expose the illusion of diversification, and let you see exactly what your money is doing. But wait, here is the absolute most crucial part, especially for my international viewers. Once you find an ETF you like, you have to look at its dividend strategy. There are two types, distributing and accumulating. Distributing ETFs. Remember those dividend stocks we talked about? A distributing ETF collects all the dividends from the hundreds of companies inside it and pays them out to your brokerage account as cash, usually every quarter. The catch: in many countries, the moment that cash hits your account, the government taxes it. Accumulating ETFs. This is the silent wealth builder. Instead of paying you the cash, the fund manager takes those dividends and instantly, automatically uses them to buy more shares of the companies inside the ETF. You don't get a cash notification, but the actual value of your ETF share goes up faster. Because the money never officially hits your personal account as cash, you completely delay paying taxes on those dividends in many tax jurisdictions. It's a pure, uninterrupted snowball of compound interest. If you are 25 years old and don't need the cash to pay your rent today, an accumulating ETF is mathematically a powerhouse. If you are 60 and want passive income to live on, a distributing ETF makes more sense. Actionable step for today: go to etfdb.com or another ETF browser, click on the asset class or type tab, and just browse. Look at how the global economy is sliced up. Find one broad U.S. market ETF and one all-world ETF. Look at their top 10 holdings. You'll be amazed at what you can own with just one share. You don't need to be a Wall Street genius to build wealth. You just need to understand the tools, eliminate the noise, and let the broader market do the heavy lifting for you. Would you like me to create a step-by-step tutorial on how to read the fact sheet of a specific ETF so you know exactly what the hidden fees are? Let me know in the comments. Keep analyzing, keep learning, and as always, keep trying to be greater.